Happy Friday, everyone, and welcome back to Your Finance TV with Jay Pelosky and his regular Friday musings. How are you, Jay?
Good, Scott. How are you?
I'm great. I'm great. I'm getting ready for some Chrissy presents for the kids and so forth, and I'm sure you are as well.
Absolutely.
Now, your musings this week are entitled "Get Real," and I feel like that's an analogy I used to say back when I was a kid, like "Get real," but as I say with the Aussie twang on the end of it. But why the title of musings "Get Real" this week?
Yeah, no, it's funny you mentioned that because that's I have that memory as well, right? It was the phrase, back in the day. I used to say it without the Aussie accent, but it still applies. Get real, like come on, stop kidding. Well, get real. Tell me what you really think, type of thing. And it struck me in several ways. So first off, we got to just say that hey, it's been a great couple weeks, right? I mean, really nice to have validation. Really nice to have validation from folks like the Fed, validating the soft landing thesis, validating, our middle path scenario, which we first started writing about 18 months ago, right? 18 months, the summer of 22, we laid out the middle path between high inflation and deep recession. And lo and behold, guess where we are 18 months later? Pretty much right there, as validated by the Fed. And so surely that has been, that's been gratifying. But even better than that is what's happened to the model portfolio, right? Because you've had a, significant pop, and the small caps is just one great example. Bespoke notes that it was a 48-day turnaround from a 52-week low to a 52-week high. That's the fastest that they've round tripped like that, the fastest in the full 50-year history of small caps. But, so the question then becomes, given all this good news and the good start to the shopping season, you even mentioned shopping for the kiddies. The question from a portfolio perspective, I think, is buy what, right? What should we buy now? Because let's face it, we've had a rip roaring rally. We have had even the laggards, the biotechs, the small caps, the fintech, even some of the climate names have had just rocket moves in the last couple of weeks. And so that's really where the title comes in. Okay. It answers the question, what should we buy? And the answer is get real, buy real assets. In other words, buy commodities. And we think that that's the opportunity set, as it stands right here today, given that most of the positioning that we've recommended and have employed in our model portfolios have had a very good run in the last 6 or 7 weeks. The thing that's kind of stuck out is there are really two. One is China, which we touched on last week. The other is commodities. And so commodities have been the laggard, underperforming bonds and stocks, not overbought. The rest of the market is as overbought as it's been in years. So commodities are not overbought. And importantly, we think they're a prime beneficiary of some positive feedback loops that we're starting to see develop across both the economy and the markets.
So, Jay, it's a bit of an unusual situation, right, with the market. Like you called it very well, and but there's a lot of people that are still naysayers in the market. There's you break it in your musings like between feelings or vibes, right? The gap between the two. Now, the feelings are it's like everyone like the general consensus feelings like they're very nervous, still in the market, but we're near all-time highs. And the vibes which you're giving out, there's positive vibes there. So break that down to us a little bit.
Yeah, that's the other part of the title, the get real part, is, as investors and as strategists, as market observers, we need to really be able to identify what is real, right? And not the story, not the hype. And I think it's increasingly difficult to do that because the gaps are so wide between the two. And so that's the other part of the get real. The first and most important, get real means buy real assets. The second is get real means understanding the distinction between facts and fiction, between a vibe session and reality. And so I have a couple of quotes, one from Paul Krugman, who I know gets a lot of negative play from people in the financial markets. I happen to think he's actually one of the better guys out there, particularly when you compare him to like a Larry Summers, who's been wrong upon wrong upon wrong and still has a platform. And Krugman talked about a Moody's report that looks into the details of the survey of small businesses and breaks out the hard data versus the soft data. And the gap between the hard data and how it comports to what actually has been happening, that's very tight. The soft data, the surveys, the questions, how do you feel about the economy type stuff, that is like record low, and yet completely wrong with what is actually happening. And then another guy I like a lot, like a quote also, Connor Sen of Bloomberg. He's one of Bloomberg's opinion columnists. I think he's a great guy to read. I read him every time he writes something. He was talking about how consumer sentiment is lower in November than it was at the lows of the great financial crisis. I mean, come on, you and I were in the business. We were in the markets at the depths of spring 2009. And it is nothing like the environment we're in today. And so it just shows you that, you know, you have to really parse through and focus on what people do, not what they say. Okay, they say in the consumer sentiment surveys, they're more negative than they were in March of 2009. What they do is they're out shopping with the retail shopping data, retail sales data that we saw the other day being quite strong, leading to the Q4 Atlanta Fed nowcast for GDP back up to 2.5%. So there's just a tremendous gap. And as investors, and when I talk to clients, it's a real big part of the discussion, kind of walk people back off the ledge and say, wait, you know, recognize things are fine. You know, the longest streak of unemployment under 4% in decades, right? 20 plus months of under 4% unemployment, inflation down to 3%. Jobs, you know, jobs plentiful, wage gains okay. I mean, it really makes it, I think, challenging, but an opportunity to take the other side and position for events just like the last 6 or 7 weeks, which thankfully we at TPW Advisory have been fully invested and fully participating in the action, upward price action of the last 6 weeks or so.
Yeah, and we've also looked ahead for look at 2024. You've called for a few macro surprises and so forth. What happens if some of those surprises happen before 2024? Does that mean you have to get some new ones? Because I think they've landed on a couple of targets already.
Yeah, no, it's again something that really has struck us over the last few weeks. I mean, we did publish our 2024 outlook, surprise, surprise, back in late October. So we're coming up on 2 months already. And we identified 4 macro surprises and 4 market surprises, what we call the 4 for 24. And we do write in this musings about 2 of the macro surprises already starting to manifest, even though we haven't turned the page into 2024. And importantly, the one that has started to manifest was our first macro surprise, namely lower than expected inflation sooner than expected. And we put that one first because that is the crux of the matter, right? How inflation moves is going to drive everything else. And that's why it was surprise number 1. And lo and behold, in the intervening 7 weeks or so since we published the outlook, inflation has come in lower than expected, sooner than expected, and leading to a Fed pivot and positioning us for a soft landing. And so that's already playing out, and we expect to see it continue to play out. And we're very focused on rent in particular, and we highlight Redfin's rental data, which suggests that on a median basis across the whole country, asking rents are down 2% year over year. It's the sharpest year over year fall in 3 years since February of 2020. And we expect that to sustain for a considerable period of time. And some folks may recall that we've talked about the explosion in multifamily building, which is going to continue to press on lowering rents because a lot of supply is coming onto the market over the course of 2024. So that's the first one. The second surprise that's starting to manifest is surprise number 3, which is the return to macro stability. And this is one, again, that we've been talking about. I think we first wrote about it back early to mid-October. And we talked about the $1 trillion reward unlock, right? All that money that has flown into money market funds over the course of 2023, as we find stability, as we return to stability, that money is going to come out of the money market funds and look for higher return asset price opportunities. And we think the VIX at under 13, the VIX is back to levels not seen since pre-COVID, fully retracing the huge spike, and it's just been gradually going down. And now we're back at around 12 or 13 to the levels that existed pre-COVID, thus the return to macro stability. Same with the MOVE index that focuses on volatility in the treasury market, same exact response. And so as we find that macro stability, we think it pertains or suggests really significant opportunity for money to come out of the money market funds, unlock that $1 trillion. And we're starting to see our first signs of it. And one example is that XLK, which is the tech ETF, had its single biggest day inflows this week. I think it was Tuesday, so before the Fed. Single biggest day of inflows in 5 years. 5 years. So that's taking us all the way back to 2018. And that is, again, kind of emblematic of what we think is going to continue and is going to sustain the upside for risk assets as it becomes more and more clear that, you know, the COVID, the inflation spike, the supply chain disruption, the Fed rate hikes, all that is in the rearview mirror. It led to stocks going nowhere for 2 years, basically flat, as we talked about last week and the week before, flat over 2 years. To us, that's fine. That's the market digesting all that rapid change and now settling into the new reality, which is going to be, in our view, better than expected global growth with low inflation, allowing the Fed to cut rates. And this is a really important point, to cut rates, not because it fears recession, but because inflation has fallen such that there's room in the real rate structure for the Fed to provide some insurance cuts. And one of our research sources, the Phenom Group, pointed this out this week. When the Fed cuts because it has room to do so, because inflation has fallen and real rates are high. Real rates typically average 0.5%. Today, they're over 2% real. So just to put that in context, when the Fed cuts in that environment, stocks tend to go up 10% or more over the course of that next 12 months. When the Fed cuts because a recession is imminent, stocks fall 15% over that next 12 months. So there's a really big gap between why the Fed cuts. And we said this last week, I think we introduced this concept. It's not when the Fed cuts, it's why it cuts that's really important to investors. And we're setting up for cutting because it has room, because inflation is falling, real rates are high, Fed has room to cut, and that is what is really constructive for risk assets.
Okay, so one of the last points you have in your musings this week is talking about the positive feedback loop. Obviously, so much good news coming through on the macro side of it and so forth. Delve into that a little bit more for the viewers and why you see this positive feedback loop.
Yeah, I mean, that's perfect. And thanks for bringing that up. I meant to mention that in the prior segment, but I forgot to. So yes, we see positive feedback loops starting to manifest. And we'll give one example is what we just kind of talked about, the Fed cutting rates because inflation is falling. And in fact, what the Fed is doing now is it's using its signaling power, signaling to the market that it's going to cut rates, right? Validating the 3 rate cuts in 2024. That allows the market to move faster and discount that before the Fed acts, thus supporting the economy. And the perfect example of this feedback loop is in the housing market, right? So when rates spiked, obviously mortgage rates spiked, and they got above 8% on, I think, the average 30-year mortgage rate, broke over 8. Well, today, given that the markets have taken on board the Fed's about face and the reality of where inflation is going, the 30-year mortgage is now about 6.8%. And the home builders, XHB, which we happily own in our global multi-asset model, our GMA flagship model, home builders are on fire, right? Just off to the moon. So that's one feedback loop. The second that we would want to mention is the idea that the market is sniffing out a win-win situation. In other words, the Fed cuts rates because it has room to do so because inflation is so well behaved. If rates go up, it's because growth is better than expected, which would be constructive for risk assets. So in a way, on both sides of the rate debate, as it's currently set up, are constructive for risk assets, and in particular, constructive, in our view, for commodities.
Okay, well, Jay, listen, this is a good rundown. I want to make sure that everyone who's watching this can make sure they sign up for your newsletter, Pelosky.com, where they can go do that. But Jay, we've got one more show left in us for this year. I'm looking forward to having that. Maybe I'll have a little Santa hat on. I shouldn't be little; it's a pretty big noggin. But thank you so much again for this week, and we look forward to talking to you again next week.
Well, likewise, Scott. But before we go, can I just flesh out that commodity idea a little bit? Because I think people are pretty skeptical. So just can I have 2 more minutes?
Okay, sure. Okay, you can talk about commodities a little bit more.
Come on, you're an Aussie, man. You guys love commodities. You're a lucky country.
Yeah.
So let's start with our investment mantra during this period, right? Okay. Inflation down, rates down, dollar down equals rest of the world outperformance, which we're playing through our emerging market equity overweight, most aggressive we've been in years in emerging markets, as well as commodities, right? And so on the commodity side, we think that's where the real opportunity is right now. Commodities have lagged. They have not participated. Energy has been a big laggard as a sector, not to mention the other segments of the commodity space. So we think that's where the opportunity is. They're not overbought. GSG, which is our the ETF kind of representative for our 10% commodity benchmark position, has a short-term RSI of low 50s. The S&P is like 77, 78. I mean, it's seriously overbought. And so commodities strike us, certainly if you're looking for that laggard opportunity, if you're looking for a way to play better than expected global growth, if you're looking for a way to play weaker dollar, commodities fit a lot of these bills. And the interesting thing is that whether you look at oil, where you have a huge sea change in speculative net positioning, a complete collapse, historic collapse in speculative net longs for oil, or whether you look at WTI under 70. One point from the Dallas Fed survey that caught our eye recently was the expected break even for drillers is in the high 60s. And so with WTI earlier this week breaking under 70, that suggests that you're really close to the point where people are not going to want to pump as much oil because it's just not economic for them. So that's usually a pretty good time to get long such a commodity. Or you can look at nuclear power. We're big believers in uranium. We just had COP28 finish this past week. Historic agreement by 20 countries to triple nuclear power capacity by 2050. Or if you want to look at copper, where a lot of reports have come out talking about 2024 production cuts. And you can even go on to ag, where hedge funds are record net short corn, even after a 50% cut in corn prices over the last 18 months. So there's a lot of negativity, right? You talked about it earlier, a lot of fear and negativity in general, but where it's really concentrated right now today is still in the commodity space, because people are still very questioning about the potential for growth. And so that's where we want to focus our attention right now. As aggressive in emerging market equity and debt overweights as we've been in years, significant overweight in commodities, which we think is the real opportunity right now today. And bottom line is that, hey, markets can get extended, and arguably they are extended at the moment. Machines, which drive the day-to-day, don't know how to sit on their hands and enjoy the ride, right? But we, humans, we can sit on our hands and enjoy the ride. And that's what we think folks should do.
Okay, well, now I'm going to let you go.
Yeah, I mean, I had that all ready to go and you cut me off. So, I mean, obviously I had to deliver that message, right? That's a pretty good one.
Machines it is a good message.
On their hands. I came up with that all by myself. I thought it was pretty insightful.
Well done. Well done, Jay.
All right, buddy. Thank you.
All right. Listen, until next week, everyone, good luck investing.